Good morning and welcome. I want to thank everyone for coming. My name is Linda Caprera. I'm with the Maine State Chamber of Commerce. I'm Senior Government Affairs Specialist, and I focus on tax issues. Thank you for coming to our webinar series number 5, the recent state and federal tax changes and how they affect your business during COVID-19. This is one of several webinar series that we've been sponsoring to try to prepare businesses and navigate issues during this pandemic. First of all, I want to thank our premier sponsors, Pierce Atwood and Whipley. I'd also like to thank our series sponsors, Central Maine Power Company, Bangor Savings Bank, and the Department of Economic and Community Development. Just a couple housekeeping matters before I introduce our speakers. All the participants will be muted. At the end, there'll be time for questions. And if you have a question, please look at the bottom of the screen with the chat function and send me your question, and I will be glad to answer them. Be glad to forward them to our speakers. So with that, I'd like to introduce our speakers today. We have 3 experts in tax. Corey Vargo, who's our first speaker, is a partner at Whipley and leads the firm's New England tax practice. Corey focuses the majority of his time on technical corporate reporting, transactional and mergers, and acquisitions related to tax issues. We also have Rob Ravenel, head of Pierce Atwood's federal income tax practice. He has extensive experience in the planning, negotiation, and tax structuring for mergers and acquisitions. Rob works closely with members of the firm's business practice group to ensure that clients obtain the most economic and tax-efficient transaction results possible. Rob's prior experience in practicing as a certified public accountant brings unique skills that enhance the value of Pierce Atwood services in deal transactions, from mergers to renewable energy, tax equity financing, to the succession of planning of closely held businesses. John Block is a partner at Pierce Atwood. He has practiced state and local tax law for more than 25 years, covering Maine, New Hampshire, and Massachusetts. John litigates state and local tax cases at the administrative level and through all levels of the court system. He also advises clients on transactional and multi-state tax issues, obtains advanced rulings for clients, and does a substantial amount of legislative and government relations work in the area of taxation. John also advises expanding and relocating businesses on taking maximum advantage of available and tax and economic development incentives. Welcome, gentlemen, and thank you for joining us. Start with our first speaker, Corey.
Good morning, everyone. My name is Corey Vargo. I'm a partner with Whipley. I'd like to start by thanking Rob and John at Pierce Atwood for working together here on this webinar. Hope we can talk through some interesting issues for you. And as you all know, the focus here will be on updates for federal and state tax law, primarily as a result of the CARES Act, but we'll have a few things that we run through that are related to IRS or state tax authority guidance and maybe some other relevant items. So we'll get going on federal and state filing and payment deadlines, go through some PPP loan forgiveness, tax deductibility issues, employee retention tax credits, the deferral of employer payroll tax obligations, corporate net operating loss changes, and similarly excess business loss limitations, accelerated refunds of corporate AMT credits, updates on the business interest expense limitation, the change for qualified improvement property, and then changes affecting retirement plans and charitable contribution deductions. And John was kind enough to remind me that I forgot to add in general state and local tax update here for the last portion, which John will run through before we open the Q&A. Next slide, please. All right, so the first thing I wanted to get into here that many of you are likely aware of, at least generally, is that many of our filing and payment deadlines for income tax have been extended to July 15th. And so in general, the IRS has extended the filing deadline for most tax returns that are due between April 1st and July 15th to a new deadline of July 15th. It includes corporate and individual income tax returns, gift and estate tax, and other tax returns, such as Form 990 for nonprofit organizations. But at this time, payroll tax filings and payments have not been extended, unless you qualify for some other benefit that came through the CARES Act that could defer some employer payroll tax obligations. But in general, those filing obligation deadlines have not changed. So as normal taxpayers can file extensions, you can still file an extension, and you can file one up to our new July 15th deadline. The IRS has provided guidance that such an extension would extend your extended filing deadline out to what it normally would have been under our old April 15th, or for, if you're looking at another deadline, May 15th or something like that for a Form 990, that normal extension date would still apply. So for 1040s for individuals or corporations due on April 15th, you would normally file an extension and get a 6-month extension to October 15th. That October 15th date is still applicable, even if you file an extension on July 15th of this year. Other than that, U.S. federal income tax payment deadlines for April 15th, as well as Q1 and Q2 quarterly estimates, have been extended to July 15th. So many people will owe tax and are opting to pay their tax for 2019 on July 15th. And many taxpayers will also make their first and second quarter estimates on that day as well. One other item I want to add in here, it's partially a deadline issue, relates to partnership amended returns. And we'll talk a little bit about amended returns and the opportunities to amend for some benefits brought forth by the CARES Act. But what I want to talk about is that certain partnerships generally cannot amend their tax returns as a result of what I'll call the new partnership IRS examination rules that came out of the Bipartisan Budget Act. And so generally speaking, partnerships with 100 or more partners, or partnerships that have other partnerships or disregarded entities such as LLCs as partners, were not able to elect out of this new partnership audit regime. And if you're not able to elect out of it, or you don't elect out of it, partnerships are not allowed to just amend their tax return for a prior year. You have to go through and file what's called an administrative adjustment request with the IRS for approval on any change that you would otherwise report through an amended return. The IRS has come out with guidance that says, because of all the things that we're going to talk about here today on this webinar with respect to the federal income tax changes, the IRS is allowing for 2018 and 2019 tax years for partnership returns to be amended up until April 8th of 2020. So basically what the IRS has said is, if you're a partnership that can generally not amend a tax return, we will allow you to file an amended return for 2018 and 2019 to take advantage of either changes in tax law due to the CARES Act, or really for any reason. They've opened it up for all partnerships to take advantage of that. And I'll kick it over to Rob now to walk through PPP loan forgiveness and a couple other items.
Morning, everybody. Thanks, Corey. Appreciate that start. So everybody is quite aware of the Payroll Protection Program loans, and I'm guessing many of you have even applied for and hopefully received some of these loans. When we first saw the statute, the reaction was that, oh, the loan can be forgiven under the right circumstances, and that it would not be includable in taxable income. And that fact raised a lot of questions, including, does that mean we can deduct the expenditures? And the general answer was, we think so, because the exclusion provision was an unusual provision to see. And so taxpayers, I think many of us went ahead with the loans under the assumption that we would also be able to get the deductions. And then on April 30th, the IRS announced that you would not, in fact, be able to deduct any of the qualifying expenses that allows for forgiveness. And while the IRS's reasoning was solid as a legal matter and is very consistent with past, again, it caught everybody very much off guard. In fact, it was issued very quietly and did not get out into the public as quickly as one might have anticipated. Nevertheless, they basically have taken away the benefit that was in the act. Many of us have been on calls with Senator Collins' office and others, and as the slide indicates, there is a movement in Congress to try to reverse that, because why did they even include that provision if they were going to take the deductibility away? So this also may have an effect on whether people want to retain the loans or apply for the loans, because again, it takes away some of the tax benefit and expectations that may have been there. The other chilling effect on the PPP loans is that the SBA had updated some guidance on who was actually eligible and what financial hardships were actually going to qualify for it. And so many people are considering returning those as well. Now, for purposes of claiming some of the other tax benefits under the CARES Act, if the PPP loans are repaid by May 14th, they'll be treated as not having ever been made, and therefore you'll be eligible for other tax benefits that you may not have been eligible for had you received the loan. So that's all I'll say there. Next slide, please. So this one item that I was just referring to that you may be eligible for is the employee retention tax credit. Now, if you have received a PPP loan, then you cannot claim this credit. But again, if you did and you repay it by tomorrow, or you just didn't apply for one, or you weren't eligible for one, you may be able to claim this employee retention tax credit. The credit is equal to basically up to $5,000 of qualifying wages. It's capped at $10,000 per employee, and it's got to be wages paid between, as you can see, March 13th and the end of the year. And eligible employers, unlike the PPP program, there's actually no cap in terms of how many employees you may have, although how many employees you have does make a difference. But there's no cap. So every employer who is in business in 2020 and has been affected financially by a COVID shutdown order, or they've seen a dramatic reduction in their gross receipts of more than 50% on year over year for each calendar quarter in 2020. More than likely, as a practical matter, very few parties probably experienced a reduction that in the first quarter of the year. But so it's really 3 quarters as a practical matter that we're looking at. But you compare each quarter year over year to see if there's a decline of more than 50%. And if so, then you'd be eligible under this. That second qualifying factor actually does not apply to nonprofit organizations, although you may see that some sources have said it does. Qualifying wages are wages with respect to employers with more than 100 full-time employees, wages being paid basically to keep people at home and not work. But if you're an employer with 100 or fewer, then all wages will apply. Oh, and I should say the eligibility for the credit will end if and when in any of the 3 calendar quarters your gross receipts increase again to at least 80% of year over year quarter receipts. Claiming the credit is going to be done on your payroll tax returns. But you can also start to get the benefit of the credit even before you file your payroll tax returns by not making employment tax withholdings deposits. So you may be able to get the credit more quickly. And this is a refundable credit. So if you actually do not have enough employment taxes that qualify for the credit that you actually pay or will have to pay, then you can still apply for a refund for the full amount of the credit. So there's really a good benefit there. Angie, if you can go to the next slide. So just a couple additional notes on the employee retention credit is if a credit has been claimed under the family's first Corona Response Act, the FFCRA, and there were credits claimed under that for Family Medical Leave Act or sick leave pay, then you cannot double dip and claim credits under the employee retention credit either. Also, again, if you got a PPP loan, then you're not eligible for this credit. And the way you determine whether you're over or under the 100 employee, full-time employee determination is the same as determining who's eligible for health benefits under the ACA, and that's at least 30 hours per week or more. Okay, we can move on here. Another benefit under the CARES Act is the ability for an employer to defer the employer portion of Social Security for amounts that would otherwise be due between March 27th and the end of the year. This deferral of the payroll taxes doesn't have to be paid until, as you can see, the end of 2021 and 2022 in 50% increments. And again, as with the retention credit, if you receive a PPP loan and it is forgiven, you will not be eligible for this deferral. Now, because people will get the loan, the PPP loan, and it won't know for some period of time that it's forgiven, the question arises, can I do the payroll tax deferral even though I might get my loan forgiven? And the answer is yes, you can defer the payroll taxes as provided up until the point that you're notified that your loan is going to be forgiven. At that point, you are no longer eligible for the employer payroll deferral. I think that's all I have there. So we can move back to Corey.
Thanks, Rob. All right, so getting into specifically some of our corporate income tax changes, the CARES Act brought forth several retroactive changes, I'll call them. And depending on specifically which item we're looking at, these changes may require amending tax returns for 2018 or 2019, let's say, filing a change in accounting method form, 3115, filing a claim for refund due to an NOL carryback, and we'll talk about that in a second here, or all of the above. So I would just stress that if any of these things pique your interest or you think they apply to you, I would reach out to your tax advisor to discuss what options you may have. But diving right into specifically the net operating loss changes, under the prior law, which was set forth by the Tax Cuts and Jobs Act, that's the Trump tax reform that came in at the end of 2017, applicable for the most part beginning in 2018 tax years. NOLs generated after 2017 can only offset 80% of taxable income and are only carried forward. There's no carryback for 2018 NOLs, 2019 and so forth. Although you can carry forward indefinitely, they don't expire. So the CARES Act added a little bit of relief here where the Congress is now allowing for NOLs arising in 2018, 2019, or 2020 to be carried back for 5 years. And they're also eliminating that 80% limitation for 2018 through 2020. But that 80% limitation will come back in 2021. So I guess I'll make this point again that these rules apply to previously existing NOLs or NOLs generated by other CARES Act changes. And again, I'll talk about a couple other items that can generate a new or a greater NOL for some of these tax years. And so real quick on this, when thinking about whether you're going to carry back or elect to not carry back under the new rules here, you'll want to consider what tax bracket you were in a carryback year. So today, also given to us by the Tax Cuts and Jobs Act, C corporations, for example, are taxed at a flat 21% for federal income tax purposes, but we had a graduated tax rate before 2018. So if you're carrying back into an earlier year and your corporation made a lot of money, you may have a significantly higher marginal tax rate that would benefit you by carrying a net operating loss back rather than carrying it forward. A couple other things that you discuss with your CPA would be any impact to corporate AMT, and then other individual specific issues if you have an S corporation, for example. Some above the line items that could be affected by your AGI. These items can change your AGI for any specific year with an NOL carryback. And then the rules for qualified business loss carryover, there could be some effect there. And those rules are quite complicated, but there could be some minor ancillary issues to think about if you feel that there's a benefit to carrying an NOL back. Next slide, please. And so I mentioned that you have to elect to not carry back your NOL. That's the way it worked before the Tax Cuts and Jobs Act, when we had a 2-year typical carryback period. When you generate a net operating loss, you have to elect not to carry it back. The second bullet here is just saying that there are special rules that apply for fiscal year starting in 2017 and ending in 18. They're allowing for fiscal year companies to carry NOLs back for 2 years rather than 5 if you have a fiscal year that straddles those 2 calendar years. And then depending on what tax years you're looking at here, where your NOL is, if you're generating a new NOL for some of the CARES Act changes, you may be filing an amended return for 2018 and or 2019, and then possibly even a Form 1045 or a Form 1139, which are the carryback refund claim forms for individuals and trusts, which would be the 1045, or for corporations, which would be the 1139. Generally speaking, you have 12 months after the end of the tax year that you generated the loss to file that carryback refund claim form, but the Congress has extended that deadline to July 27th, 2020 for 2018. So for 2019, it's possible that you'll have even more time there. So just a couple more points on this. If you need to file an amended return for 2018 or 2019, keep in mind that the amended return must be processed before your refund claim form. So your amended return needs to be, the amended return that will generate the NOL that you'll carry back has to be processed by the IRS before you file the 1045 or 1139. I bring that up because we're expecting IRS processing times to take much longer than normal in several areas. So for example, right now, they're really not taking phone calls from taxpayers. Most recently, they haven't been opening and processing paper filings. That may be changing or may have changed recently. So that's something that we need to keep in mind here, and you should be careful about the timing of your filings. And so it may be most efficient to amend a return for 2018 and 2019 and then file the 1045 or 1139. You can always amend 2018 or 2019, generate the NOL, and then amend the actual carryback year, although that's likely less efficient. And if you pay for a CPA to do your taxes, it would probably cost more as well. And the last point that I'll bring up here before I get into excess business loss limitations is that a lot of M&A transactions that occurred, well, I should say M&A transactions that occurred prior to 2018 most likely directly contemplated or restricted the ability of a buyer corporation to carry a net operating loss back into a pre-acquisition period, or at least would require or set forth certain requirements that there be communication and cooperation between the buyer and the seller if a carryback would be beneficial to one party or both. When NOL carrybacks went away after 2017, M&A agreements, stock purchase agreements, et cetera, have largely been silent on the NOL carryback because it didn't exist for federal income tax purposes for 2018 and 2019. And so now that we are able to carry 2018 and 2019 back, this is a provision that could drive some parties that have executed transactions over the last couple of years back to the negotiating table. There could be a current benefit here that could benefit both parties, depending on the tax bracket that the corporation was in at that time, among other factors. So I wanted to bring that up, and Rob brought that to my attention. So Rob, I guess I just want to pause and ask if you have anything to add there.
I think you've covered it pretty well, Corey. Yeah, I mean, this is my world, and that's an issue that for many years we had negotiated over, and it kind of disappeared. But you're absolutely on point that it's an issue we're already thinking about when it comes to transactions involving C corporations.
Great. Okay, so moving forward, I know we're pressed for time and we got a lot to get through. The next item is kind of similar to corporate net operating losses, but is a little different, the excess business loss limitation. This is basically the NOL limitation that's placed upon individual Form 1040 filers, so single or married filers, on the amount of business losses that you can take in any given year. And so it allows you to take $250,000 if you're filing single, or $500,000 if you're filing married, of an excess business loss in any given year. And then the amount on top of that will carry forward as an NOL. Under the CARES Act, basically they're removing that limitation for 18, 19, and 20. And so if you have a large excess business loss, which could differ from your regular net operating loss carry forward, it may behoove you to go back and review, or ask your CPA to review a prior year return to say, hey, if I amend this, can I generate a net operating loss? And if I can increase my net operating loss for that year, can I carry it back and get a benefit or a refund for a prior year to either get the cash now, so I don't have to wait to use my net operating loss in the future, or to offset it against taxable income when I was in a higher tax bracket, depending on your specific tax profile and circumstance. So a couple other quick things here. There are other small technical changes here with the CARES Act related to excess business losses. We don't need to get into too much detail, but the interaction of the excess business loss with taxable wages, so if you have W-2 income too, changes a little bit. And as I mentioned, I would just say, if you're familiar, you don't know if you have an excess business loss limitation for 18 or 19, look at your return, talk to your tax preparer, and there may be some planning there. And so I'll go ahead and kick it back over to Rob.
Thanks, Corey. Yeah, so this is a provision in the CARES Act that really is only applicable to C corporations, as it notes that back the TCJA had repealed the corporate alternative minimum tax as of 2018, even though a lot of taxpayers, corporate taxpayers, would have had alternative minimum tax credits available because they paid AMT in prior years. And so the TCJA had permitted them to take those credits and get basically a refund for them over a number of years following the effective date of the act. The CARES Act is accelerating the ability to get those refunds. And so you can claim it on the 2019 tax return, which many have probably not yet filed, or you could even try to get it back in 2018 if you file an amended 2018 return. But that return claim must be in by the end of this year in order to get it in 2018. So there's a potential for additional cash flow for corporations if they had credits that they hadn't been able to claim yet. So back to you, Corey.
All right. Okay, a couple more corporate income tax changes here that'll round out my end of the webinar. So business interest expense limitations, another Tax Cuts and Jobs Act issue that applies generally to corporations or other businesses that so S corps, partnerships, et cetera, and it could be 1040s if you have a Schedule C business. A limitation that applies to businesses that have greater than $25 million in sales on average for the last 3 years. And so the law as passed in 2017, limits interest expense deductions to 30% of what's defined as adjusted taxable income. And then any amount beyond that 30% would be a disallowed expense in the current year and then carried forward until you're able to use it in a future year. And so the CARES Act has increased that limitation from 30% of this defined adjusted taxable income to 50% of what I'll call ATI for 2019 and 2020, which can give you an opportunity for additional deductions. And so for taxpayers that have already filed their 2019 return, this could be an opportunity for a pretty valuable amended return opportunity here. Next slide, please. And so a couple other minor things. So for starting in 2020, I'm sorry, for years that begin in 2020, taxpayers can elect to calculate the limitation using their ATI amount, that adjusted taxable income amount, for a tax year beginning in 2019. And that can be favorable if, so we're saying 30% of your ATI, which is now 50% of your ATI, is the amount of the interest expense that you can take. It'll likely be favorable to take the 2019 number if your business has been impacted by the coronavirus epidemic, the pandemic, and your taxable income will be lower for 2020. Using 2019 as that benchmark could create a higher limitation amount and a higher deduction for you. And then the final point here about partnerships basically just says any limitation or deduction on interest expense at the partnership level will just pass through to the partnership's owners anyways, and the business interest expense limitation would apply on that partner's return. So this says the 50% limit doesn't apply to a partnership, it will apply to the partnership's owners for the given year. And again, this is one of those opportunities that could be pretty significant for some tax savings here if a return has already been filed. And then my last point for the presentation relates to the qualified improvement property fix. This is referred to as the retail glitch. Basically, Congress messed up when they drafted the Tax Cuts and Jobs Act and they didn't catch their mistake before it was signed into law. Qualified improvement property, things like leasehold improvements, accidentally got bucketed in with 39-year other real estate property and was not eligible for bonus depreciation because of that mistake. The intention of the law, even though it was written poorly, well, just flat out written wrongly, was that such property, qualified improvement property, would be 15-year depreciable life and would be eligible for bonus. So the CARES Act fixed that mistake, and which creates a couple of issues. One could be a benefit, a sizable benefit, depending on the business. But one is actually a compliance issue that needs to be worked out. So for 2018 and 2019, taxpayers that had qualified improvement property placed into service took one of two actions. They placed it in service and began depreciating it over 39 years, or they took Section 179 expense deduction on that property, which, similar to bonus depreciation, would result in 100% first year expensing. So if you took Section 179 when you placed that asset in service, I should say generally that you're okay. You don't need to worry too much about this. But if you placed QIP in service in 2018 or 2019 and you started depreciating it over 39 years, you have to take action at this point because it is not an election or it is not optional to choose between 39-year and 15-year. And it is a retroactive provision that this is fixing. So taxpayers need to either amend a prior year return to, this is if you're depreciating it over 39 years, you need to either claim bonus depreciation or change the useful life on that prior year return from 39 years to 15 years, or 20 years if you use the ADS system of depreciation. Or the second alternative here is to file a change in accounting method rather than amending a prior year return. On your next return, you can change the accounting method, calculate what the difference in depreciation would be, attach that to your next tax return, and run the difference through taxable income that way. If you placed it in service and took the 39 years and you don't take these actions, IRS released a revenue procedure that requires taxpayers to basically stop depreciating the asset and reduce tax basis to zero. So you cannot continue to depreciate under 39 years. And if you don't fix it, the IRS says you don't get anything. So this is something to keep an eye out for. I think it would be limited circumstances where you didn't take bonus, but from a planning perspective, I think some taxpayers could have gone with the 39 years. But it's worth keeping an eye out for, and certainly CPAs that prepare business tax returns need to be aware of this and cognizant of any changes that need to be made. So I'll kick it back over to Rob to get into some of the retirement plan changes.
Thanks, Corey. So yeah, just a few things here. The biggest and probably most beneficial provision that came out of the CARES Act from a retirement planning standpoint was the suspension or need to not have to take a required minimum distribution from your retirement accounts in 2020. So that's a huge benefit to retirees who may have had to liquidate assets which had dropped with the stock market drop, and then take a loss, and then take income that they may not need anyway from the minimum distribution required. So this is a big help to people, and it is not a deferral like so many things are under the Act, but this is an actual wipeout. There is no obligation to take a distribution this year. Another provision is the ability to take up to $100,000 in loans from employees' 401ks if it's done between March 27 and September 23rd of this year. And the loan repayment period will be extended to 6 years for those loans. So that's a substantial amount of money for a lot of people to be able to withdraw if they're having cash flow issues. In addition, account holders who are at least 59 and a half years old can actually take a distribution. I'm sorry, not 59, under 59 and a half years old, may take a distribution of up to $100,000 without incurring the 10% excise tax penalty. But they will still have to pay income taxes on that, although the taxes attributable to the distribution will be spread out over the next few years. So that there's some substantial benefit there. Again, a source of cash flow without having to pay that 10% penalty would be huge. All right, next slide, please. So we'll just touch quickly on charitable contribution changes as well, and then we'll turn it over to John to let you know how all of this works on the state side. Probably the most important provision here for the average person is the ability to make a charitable contribution of $300 and still deduct it, even if you're not otherwise itemizing your deductions because of the increase in the standard deduction. So that's what we call an above the line deduction now, and that hopefully is something that will be beneficial for people who really do want to get a tax benefit for their charitable contributions. Another change is normally there's a limitation on the amount of cash contributions you can make to 60% of your adjusted gross income. But for 2020, there is no limit. So in effect, you could deduct up to 100% of your adjusted gross income in 2020 with charitable contributions. And you can still make direct charitable contributions from IRAs in 2020 up to $100,000, even if you don't otherwise take a required minimum distribution. So for retirees who are charitably oriented, 2020 actually could be a good year in many ways. So that's my portion. John, we'll turn it over to you.
Sure. Thank you, Rob. So I'm going to start with filing deadlines. And Maine, like the federal government, has extended many filing deadlines. The April 15th deadline was extended to July 15th, and that applies to 1040s, 1041 MEs, 1120 MEs, 1120B, that's the bank franchise return, and 2020 estimated payments that were due on April 15th. It's important to note this does not apply to any other tax types, so it does not apply to trust fund taxes like employee withholdings, fuel taxes, things like that. Does not apply to sales tax. They later extended the June 15th second quarter estimated tax payment deadline also to July 15th. And that includes estimated and final income and franchise tax payments that were originally due anytime, this would be for fiscal year taxpayers, anytime between April 16th through June 15th. Maine does have the automatic 6-month extension that's still available for income and franchise tax returns. So like the federal extension, if you can have an automatic extension that would change your filing date from April 15th to October 15th. And as usual, that extension is not an extension to pay. And in order to avoid penalty, the taxpayer would have had to pay at least 90% of the tax owed by July 15th to avoid penalties and interest. So those are the main filing deadlines currently. Next slide, please. So everything you've just heard about all these CARES Act tax benefits, unfortunately, none of that stuff really flows through to Maine taxes at all yet, and that's because Maine has not conformed to the CARES Act. The legislature hasn't even been in session for the last couple of months and hasn't even had an opportunity to consider that. So all of those benefits you've just been hearing about for the last 45 minutes are really federal only, unless and until the Maine legislature comes back and decides to conform to any of this. Right now, Maine tax laws are conformed to the Internal Revenue Code as of 12/31/2018. So that is going to complicate Maine tax filings. Your tax preparers are going to have a lot more headaches because there will have to be a lot of adjustments made between federal taxable income and Maine taxable income. So that's unfortunately comes with the territory. Also wanted to say that the forgiveness, because of the non-conformity to the CARES Act, forgiveness of PPP indebtedness may be subject to Maine income tax because the provision that relieves the forgiveness of PPP indebtedness from federal tax is in the CARES Act, and Maine has not yet conformed to that. So that's another issue with the PPP process for Maine income tax. Next slide. Wanted to say a few things about Nexus and remote employees. Just something to keep in mind. If you have employees that are working at home, they normally would have worked somewhere in an office or someplace, but they've been forced to work at home in a state where the employer doesn't have Nexus. Normally, an employee working in a state will create tax Nexus for an employer. There are some exceptions to that, but the general rule. And you may also have to be withholding income tax on employees that are working in these other states because they're working there. So you'd have to withhold that state's income tax. And then something to keep in mind with regard to residency, with people getting stuck in different places that they're not used to working because of coronavirus. Just keep in mind that if a non-resident that has a permanent place of abode in Maine and spends more than 183 days in the state, that creates statutory residency and makes that person a resident of Maine. And that would be true of most states. Some other states have dealt with these things and made special exceptions on Nexus and things like that. Maine has not done so. So It's the status quo with regard to Maine on these issues. Next slide, please. Maine Revenue Service has put out some guidance in their FAQ page on the Maine Education Opportunity Tax Credit, which I think is worth mentioning here. And this relates to the CARES Act. So the CARES Act allows for an optional ability to temporarily suspend certain kinds of federal student loan payments. And the issue is the Maine Educational Opportunity Tax Credit only applies to loan payments that are actually due. So Maine Revenue's guidance is that in order to continue to claim the Maine Educational Opportunity Tax Credit, the taxpayer must affirmatively opt out of that temporary suspension. And there is a process for opting out. It involves contacting the lender. So if the taxpayer does not opt out, that means that there are no required loan payments during this period. So there would be no Maine EOTC available during that suspension period. And just keep in mind also the taxpayer must continue to meet all the other requirements, and they have to be employed at least part-time, at least 16 hours a week in order to maintain eligibility. So that's an issue with people losing their jobs at this point, being furloughed. So this is guidance put out on Maine Revenue's website, and all of this is based on existing law. You know, when the legislature comes back, they may want to change some of this, but this is the current situation. Next slide, please. Property tax, some property tax issues. The deadlines have been extended for applying for various property tax exemptions. The extension is to the municipal tax commitment date, or 30 days after the state of emergency is terminated, whichever occurs first. So the municipal tax commitment date varies by town. Every town has a different date. It depends when town does it. So you would only be able to get that date by contacting the town. And many towns wouldn't know when that is yet. 30 days after the state of emergency. So currently the state of emergency is scheduled to end in 2 days on May 15th. We'll have to see if that is extended in the next 2 days, but so that could be triggered soon. Next slide, please. I've been asked a lot about the April 1st valuation date. So for Maine property tax purposes, everything is valued as of April 1st. Everything is determined as of April 1st. So people are saying, well, my business was required to be closed on April 1st. I couldn't rent out my hotel rooms, et cetera. Does that mean I can get a property tax abatement because my value of my property was had tanked on April 1st? Unfortunately, the answer to that in Maine is probably no. And that's because there are a series of Maine Supreme Court cases, one of which was involved a situation during the Great Depression, which basically say that for valuation purposes, the assessors can ignore temporary and extraordinary fluctuations in value, but they should be looking at more a longer time horizon. And the Maine Supreme Court has also emphasized the competing need for municipalities to maintain their predictable revenue base. So it will be very difficult to make that argument in Maine at this point. So I think that leaves us with about 10 minutes for questions and answers.
Yep. Hi, we've got a couple questions that I received. One is, and I'm just going to throw this out to all three of our speakers, and just jump in if you want to answer. Do you expect in the more tax changes at the federal level with the new stimulus package that Congress is talking about, Stimulus 4, I believe it is, and have you heard anything, or what are you hearing around kind of your professions? And I just throw that out. are you hearing anything at all?
I can chime in on that. This is Corey. The House has proposed a bill, or they're at least circulating a bill that it sounds like may be voted on soon in the House, that will have some additional income tax changes. So the big one that I know is actually quite a political issue is with respect to the individual income tax deduction for state and local taxes. The House's bill would roll that back and repeal it retroactively. And so there are several other items in the package that are really political issues that until now have been non-starters for the Senate and the president. So it would surprise me if this bill is passed and we get these changes, specifically the tax changes, as currently drafted. But it wouldn't surprise me if there are changes at all, but some of the bigger ones strike me as quite partisan at this time.
Okay. Anybody else?
No, I think that's all I've seen.
Okay, another question I received is, in other states, I know some of you have offices around the country, and what are you seeing in other states in respect to how they're dealing with conformity issues with respect to all these changes that are coming down? And I know that some legislatures are not in, but some are. And are you hearing anything about the conformity issues, whether they're conforming or non-conforming on the state levels? I'm going to throw that out there as well.
So this is John. Different states are doing different things. I don't think many states have conformed to these CARES Act provisions, and most state legislatures are not in. Certainly none of the states around New England that I'm aware of have done so. I think we might see more of that over the summer as things get relaxed, hopefully, and legislatures might be able to come back for special sessions.
Okay.
So I think we'll have to wait and see.
Okay. Anybody else?
No.
Okay, well, I think we're going to wrap up. Thank you very much to our speakers. And again, thank you to our sponsors, Pierce Atwood and Whipley and Bangor Savings Bank, Central Maine Power Company, and the Maine Department of Economic and Community Development. And thank you to all of our participants in this webinar. This is recorded, so it will be available on our website. Again, thank you, gentlemen, for all of your comments. Very valuable, especially to Maine businesses. So thank you again, and we'll see you later.
Great. Thanks for having us.
Thank you.